The stock market is a lot like us. It has its ups and downs, its moments of excitement, and its bouts of fear. And just like us, it reacts to the world around it. But there's one thing that really gets the market's gears turning. One event that can send it soaring with optimism or spiraling into a panic. Elections. Think about it. Elections are all about change, about new leadership, new policies, and a whole new vision for the future. And for investors, change equals uncertainty. Uncertainty about where the economy is headed, uncertainty about which industries will thrive, and uncertainty about what their investments will be worth a year, a month, even a week from now. That uncertainty can make the market jittery, like a caffeinated trader mainlining coffee and market news. But here's the thing. While the average Joe might throw their hands up in frustration, savvy investors know that understanding the link between elections and the market is like having a secret weapon, a way to cut through the noise and make decisions that can pay off big time. Let's face it, most folks don't associate elections with investing. They think about candidates, campaigns, and maybe even the fate of the free world. But for those who play the market, elections are more than just a civic duty. They're a high-stakes game with real financial consequences. Imagine this, you're an investor, and the election season kicks off. Suddenly, every speech, every debate, every poll number becomes a potential market mover. Will this policy send stocks soaring? Will that comment trigger a sell-off? It's enough to make even the most seasoned investor break a sweat. And it's not just about the immediate aftermath of an election. The policies enacted by a new administration can have ripple effects for years to come, shaping entire industries and influencing market trends for better or worse. Think of it like this. Elections are the opening act, but the real show, the one that investors really care about, is the long-term impact on their portfolios. So how exactly does this political drama translate into market movements? It all boils down to one word: expectations. Investors are obsessed with predicting the future, and elections offer a tantalizing glimpse into what that future might hold. When a candidate promising business-friendly policies takes the lead, investors get giddy, anticipating a surge in corporate profits and a bull market to boot. But if a candidate with a more interventionist approach gains traction, well, let's just say the market tends to get a little skittish, fearing higher taxes, tighter regulations, and a potential hit to the bottom line. But here's the catch. It's not just about the actual policies themselves. It's about how the market perceives those policies, about the narratives that take hold, and the sentiment that drives investment decisions. In the world of investing, perception is reality, and understanding that reality is key to navigating the often turbulent waters of election-driven market volatility. Before we dive into the nitty-gritty of how elections rock the market's boat, let's get back to basics. Imagine the stock market as a giant online marketplace, kind of like Amazon, but instead of selling books and toasters, it's selling pieces of companies. These pieces are called stocks or shares. Companies issue stock to raise money. They're basically saying, hey, want a slice of this pie we're building? Investors, both big shots and regular folks, buy these stocks, hoping their value will go up. It's like buying a house in a hot neighborhood. You're betting it'll be worth more down the line. But here's the kicker. The stock market is driven by supply and demand. When more people want to buy a stock, high demand, its price goes up. When more people want to sell, high supply, the price drops. It's like that limited edition sneaker everyone's after. The fewer pairs available, the higher the price tag. Now, where do elections fit into all of this? Well, they have this pesky habit of shaking up the whole supply and demand game. Depending on who wins and what policies they push, investors can get spooked or ecstatic, leading to those wild market swings we all love to gossip about. Factors that move the market. It's not just about politics. Sure, elections get the headlines and make investors sweat, but they're not the only game in town. The stock market is a fickle beast, swayed by a whole cocktail of factors, some predictable, some not so much. First up, we've got the economy. When businesses are booming, unemployment's low, and people are spending like there's no tomorrow, the market tends to party hard. Think of it as the market's own personal happy hour. But when the economy catches a cold, the market feels the chill, and investors start reaching for the antacids. Then there are interest rates, those tiny numbers that can have a huge impact. When interest rates are low, borrowing money is cheap, businesses invest like crazy, and the market usually gets a sugar rush. But when those rates climb, borrowing gets pricey, businesses pump the brakes, and the market might just need a nap. And let's not forget global events. Wars, natural disasters, even a good old-fashioned pandemic can send shockwaves through the market faster than you can say, sell, sell, sell. It's a reminder that the stock market, for all its complexities, is still connected to the real world, with all its messy realities. Decoding market sentiment, the fear and greed index. Now let's talk about something a little less tangible but just as important, market sentiment. Imagine the collective mood of all investors rolled into one giant emotional roller coaster. When investors are optimistic, feeling bullish, they buy, sending the market skyward. Think of it as the market's version of a shopping spree. But when fear takes hold, when investors get bearish, they head for the exits, selling off stocks and sending the market into a tailspin. It's like someone yelled fire in a crowded theater, except instead of popcorn flying, it's billions of dollars changing hands. This constant tug of war between fear and greed is what makes the market so unpredictable, so exciting, and let's be honest, so damn nerve-wracking. And guess what? Elections? They're like throwing a whole pack of Mentos into a bottle of Diet Coke when it comes to market sentiment. Think about it. Elections bring uncertainty, and uncertainty breeds both fear and opportunity. Will the new administration be good for business? Will they tank the economy? Nobody knows for sure, and that's where the real drama begins. Tax cuts, regulations, and market jitters. Remember how we said the market thrives on certainty? Elections throw a wrench in that whole equation. Every candidate has their own economic playbook. Tax cuts can feel like an early Christmas for investors. Lower taxes mean higher profits and happy shareholders. But regulations act as brakes on the economic engine. Too much regulation can make investors nervous. The mere hint of policy shifts can send shockwaves through the market. Elections don't just impact the market as a whole, they create winners and losers within specific sectors. Think of it like a political stock market game show. Take healthcare, for example. During election years, healthcare reform makes the sector a nail-biter. Will there be a push for universal healthcare? More deregulation? Depending on the answers, stock prices could soar or plummet. Elections can be make or break for oil, gas, and renewable energy companies. The answer can send shockwaves through the energy sector. And let's not forget about defense. A tough stance on national security can boost defense stocks. Let's talk about how elections can rattle the market. The Trump and Biden years sent shockwaves through Wall Street. Trump's 2016 victory initially sent the market into a tailspin. Investors panicked, sending the Dow tumbling nearly 1,000 points overnight. But Trump's pro-business policies turned the market around. The Dow soared to record highs, fueled by investor optimism. Biden's election brought its own market drama. His focus on infrastructure and clean energy created new market dynamics. All right, let's talk about the government's spending habits, because they have a huge impact on your investments. We're talking about fiscal policy, the government's strategy for taxing and spending. It's like the government's own personal budget, except they're deciding whether to build new roads or cut taxes. When the government spends big, it can be a boon for certain industries. Their stocks might get a bump as investors anticipate a surge in spending, but increased spending often means a bigger budget deficit, and if that deficit gets out of control, it can spook investors. Monetary policy, the Fed's balancing act. The Federal Reserve, aka the Fed, controls the money supply. They're like the economy's referees, setting interest rates and controlling money flow. Think of interest rates like the price of money. Lower rates make borrowing cheaper, boosting business investments and market rallies. But if inflation rises, the Fed might raise rates to cool the economy. Higher rates can dampen corporate profits and make investors nervous. The regulatory roller coaster from deregulation to crackdowns. Regulations are those pesky rules governments put on businesses. Some are necessary, like ensuring food safety and stable banks. But too much regulation can make investors panic. Businesses need clear rules to plan and invest. Deregulation often excites investors, promising economic growth. They see it as a green light for profits to soar. But the regulatory pendulum can swing both ways. What one administration deregulates, another might regulate tightly. The Reagan Revolution, morning in America, boom time on Wall Street. The year was 1980. America, weary of economic malaise and yearning for a return to greatness, elected Ronald Reagan, a charismatic former actor who promised to unleash the power of free enterprise. The stock market, sensing a seismic shift, held its breath. Reagan's prescription for what ailed America? Tax cuts, deregulation, and a hearty dose of optimism. He slashed taxes for businesses and individuals, rolled back regulations across industries, and declared it morning in America. The stock market, like a flower basking in the sunshine, responded with a surge of growth that would define a decade. The Dow Jones Industrial Average, a key barometer of the market's mood, nearly doubled during Reagan's 2 terms. Investors, emboldened by Reagan's pro-business policies and the surging economy, poured money into the stock market, fueling a bull market that seemed to defy gravity. It wasn't just about tax cuts and deregulation, though. Reagan's infectious optimism, his belief in American exceptionalism, created a sense of confidence that permeated the business world and beyond. Suddenly, it was cool to be a capitalist, to invest in the stock market, to believe that America's best days were still ahead. The late 1990s witnessed the rise of a new economic force, the internet. Investors poured money into anything with a .com at the end of its name. The stock market entered a period of unprecedented growth. Companies with little more than a website went public, their valuations soaring. But like all bubbles, this one was destined to burst. The .com crash was swift and brutal. The 2008 financial crisis was a perfect storm of financial engineering, regulatory failure, and unbridled greed. It was a slow-motion train wreck that began years earlier with the deregulation of the financial industry and the rise of subprime mortgages. Wall Street banks, flush with cash and eager to create new profit centers, bundled these risky mortgages into complex financial instruments known as mortgage-backed securities. These securities, marketed as safe investments, were sold to investors worldwide, spreading the risk throughout the global financial system. When the housing bubble burst and mortgage defaults soared, the value of these mortgage-backed securities plummeted. Banks, saddled with toxic assets and facing a liquidity crisis, stopped lending to each other, effectively freezing the credit markets. The stock market, reflecting the mounting panic, went into freefall. The Dow Jones Industrial Average lost more than half its value from its peak in October 2007 to its trough in March 2009, wiping out trillions of dollars in wealth. The financial system teetered on the brink of collapse, requiring massive government intervention to avert a complete meltdown. The 2008 financial crisis was a stark reminder that, even in the 21st century, capitalism is not infallible, and the consequences of unchecked greed can be catastrophic. In the aftermath of the 2008 financial crisis, the Federal Reserve, led by Ben Bernanke, implemented near-zero interest rates and quantitative easing. These policies helped prevent a deeper recession and set the stage for a bull market. The Dow Jones began a steady ascent. Eventually surpassing its pre-crisis high in 2013, the bull market continued for nearly a decade. Donald Trump's 2016 election brought optimism among investors, boosting corporate profits and market gains. The Trump bump was real, but his presidency also brought market volatility with unpredictable tweets and trade wars. Watching the market gyrate during election season can make even the most seasoned investor want to crawl under a rock. But panic is not an investment strategy. The stock market is like the ocean, and elections are like storms. Sure, those storms can be intense, but the ocean always calms down eventually. Ships that stay the course reach their destination. The same goes for investing. Keep your eyes on the long-term horizon. Remember why you invested in the first place. Time, not timing, is your greatest ally in the market. The storm will pass, and your portfolio will thank you. Nobody, not even the most plugged-in political pundit or Wall Street guru, can predict with certainty how an election will impact the market. Too many variables, too many unforeseen events, too many black swan moments. So what's an investor to do? Hedge your bets. Diversify, diversify, diversify. It's the oldest rule in the investing playbook, and for good reason. Don't put all your eggs in one basket. If that basket is on the wrong side of an election, you're in for a world of hurt. Diversification spreads your risk and protects your portfolio. Election season is a non-stop media circus, a 24/7 news cycle fueled by speculation and spin. Most of that noise is just that, noise. Investors should focus on the fundamentals. Look at earnings, debt levels, management, and growth prospects. These factors determine a company's value. Don't get distracted by political theater. Focus on the fundamentals and invest in companies built to last. So there you have it. We've dissected the wild world of elections and their impact on the stock market. We've explored the history, the policies, the emotional roller coaster that investors ride every time a new administration takes the helm. The bottom line? Elections matter. They matter a lot, but they shouldn't paralyze you as an investor. In fact, understanding the interplay between politics and the market can be your secret weapon, your guide to navigating the inevitable volatility and coming out ahead. Remember, knowledge is power. Stay informed about the key factors that move the market, the policies that impact specific sectors, the historical trends that can offer valuable insights. But don't let the 24/7 news cycle, the pundit predictions, or the Twitter tirades rattle your cage. Keep your eye on the long game. Diversify your investments. Focus on the fundamentals. And above all else, remember that the market, like the ocean, has weathered countless storms before and it will weather countless storms again. Stay calm, stay informed, stay invested, and you'll be well positioned to ride those waves of uncertainty and reach your financial destination. And hey, if you found this deep dive helpful, don't forget to hit that like button and subscribe for more videos like this. We'll see you in the next one.